Good morning, traders, and welcome to the weekend update here for, it's February 18th. Our markets are closed for tomorrow for President's Day, but I wanted to go ahead and get this recording out there for everyone. And again, we'll review our current open trades and take a look at market expectations for the coming week. So as far as open trades, first of all, we did have one that closed this week. It just expired and expired at about a 4% profit, as I recall. That was the SPX that we turned into a no risk or a no lose butterfly trade. And if the market needed to pull back a fair amount, it would have created a nice potential profit. That didn't happen, but it still went out at a small profit. So again, that one expired. It was an AM expiration, so it expired first thing Friday morning. Now, our other trades, as you recall, I was expecting possibly a little bit of a pullback. So I was a little leery to adjust too many of these for an upside move. So the game plan here, this trade, this calendar should start to decay fairly rapidly come Tuesday. The goal will be to hopefully have the market stay in a range here and start popping these off. There's already an order out there to remove one of the double calendars for $2. And again, the goal here is to hopefully have this decay pretty rapidly right in this general range. Once that one pops off, then we'll want to quickly look at taking the other one off. You don't want to get into midday Thursday and still have a calendar on. The gamma risk just gets too high at that point. So that will be the game plan on this trade. This trade here, if we were to think that we're done on an upside move, that we were not going to go higher, a call spread could potentially be added to this trade to juice it a little bit. I'm a little reluctant to do that. You'll see why when we get into the market analysis segment. Of course, this trade has been a little bit problematic. We got whipsawed on this one. The markets were moving pretty heavily to the downside, a week and a half or so ago based off a CPI number. So this trade was adjusted to basically be set up for more downside risk. Then, of course, our market ripped back up. And he adjusted it to remove some of the upside risk and reposition that risk to downside risk. And, that's where we set right now. But when you get that whipsaw, this sort of thing can certainly happen. So this thing expires in 2 weeks. The goal here at this point is going to be to reduce the potential loss in this trade. It may not be to work toward much of a profit. Because if we let this decay too long, into expiration week, then that gamma risk gets massive again. We'll talk more about that when the appropriate time comes for an adjustment or for thinning that trade out. This particular, the flat fly with the long call, again, that was a little bit dicey when we were up in here, and a case could have been made to take this entire tent off and move it up, or potentially remove one of our spreads on this side. Those are a couple likely adjustments, or move our long call in a little closer so that this gets supported a little bit better in an up move. All of those are possibilities, but on this one, since it doesn't have any severe upside risk at this point because we have that long call in place, I kind of want to wait and see how our markets react come Monday. If they pull back a little bit further into here, that would be ideal. There is an order out there to thin out one more of these butterflies. So that's a GTC order that's been floating out there at 1450. Again, I'd like to get one of those popped off. That helps reduce our risk across that whole trade, and it helps make our one remaining long call support this upside a little better. So that would be the ideal situation on this one, is that we get a pullback here and a little more decay happening to where we're able to pop one of the butterflies off, and then we can just let that set and decay a little further. But if not, if our market does start to move up more rapidly here, etc., we're going to have to look at an adjustment there. This trade is doing just fine. Again, I like the range that it's in. Just going to let this decay a little bit. Obviously, this expiration is out there quite a ways. And then we just recently added this one. I like this. This was a good entry. Normally, these butterflies, I think you saw when I put out the trade alert, this broken wing configuration, 50-60 butterfly, 50 on the upside, 60 on the downside, normally it's about $1.90 to $2.10 to get into this trade. Well, at one point, there was a chance of getting into this trade, I think, for as little as 80 cents, and I had a GTC order out there all day. That was the day that we sold off on that particular CPI number. We did not get a fill, so I tried again the following day and then the following day, and finally did get a fill, but not at that favorable price I was originally looking at. As I recall, I ended up getting into this for $1, if I remember right, which again is still a significantly better price than it would have been in a lower volatility environment. So I like the entry on this trade. We've got a very flat T0 with very limited upside risk. So if our market does rip up, 5,100, etc., this should be a fairly easy trade to adjust. If our market sells off 100 points, that won't have a huge impact on this trade either. And again, it should be fairly easy to put adjustments in on this. I like it when I get a good entry. It allows me to extract more potentially out of the trade as time goes forward. I can look for a higher level of a potential profit target on this. Again, there's a lot of time left in this trade, a couple of months before this gets taken off, because I usually like to take them off, 2 weeks or so before expiration. So that's still about 60 days out. So again, a lot can happen in there, but I like that entry at this point. I think that will end up working well on this trade. So what does our market look like now that we've taken a look at our existing positions? So here's our market. And again, this is the SPX. We're in a very still solid uptrend. We certainly had a pretty significant sell-off based on that CPI number. 100 points. And then we rallied really hard back up for 3 days. And then on Friday, we had the PPI number, which also wasn't received very well, and that created this little bit of a sell-off here as well. We can see that here. This is our futures markets after that number. Actually, this was after the number came out. Then we rallied all day long. Going into the close, we sold off again. So what are the expectations from here? Well, I want you to see, first of all, that we have this major trend line that's been in place for quite some time. And that's still intact. And as I said last week, I was expecting this, 5,000, 5,025 mark, whatever, to be a little bit of a cap on our move. I expected that we probably were not going to bust above that. Again, I never say for sure. I kind of put odds on it. And if I remember right, I said there's about a 65-70% chance that this will act as a cap and will roll over at that point. As soon as we rolled over, this is when I came in and tried to put that butterfly trade on, because my expectation then was that we rolled down to this trend line. And also we can see right across here, there would have been support based on these two bars and then these two bars. So these bars were basically former resistance. And then when we finally popped through and sold back there, it acted as support. So there's a battle line, if you will, right across here at that 49.20 range. So that's why I was trying to get into that butterfly trade when we pulled back to here, because my expectation was that we would move back higher from there and that volatility would decrease a little from there. So that was the premise or the theory. Again, did not happen to get the fill on that day at that desired 80 cents or 85 cents. But anyhow, we're in that trade now, and it's holding up fine. So my expectation is right now that this 50-40, 50-50 range is still probably going to hold for a little bit longer. I would expect a pullback maybe down here to this 49.30 range, 4,900 range, somewhere down in here, and then probably a move back up, then maybe a little bit of a sideways, and then ultimately probably a pop through. We're still definitely in a very bullish market. We're continuing to make, higher lows and higher highs. So we're definitely still in an uptrend. We're also creating a large wedge pattern, as we can see by this line and then this line. Wedge patterns oftentimes tend to break the direction of the wedge. So this wedge is certainly pointing up. It's going higher. And again, more often than not, that means that the buyers will end up overwhelming the sellers at some point. And when that happens, that's when you get another breakout here. So I really want to be a little careful about, putting on an upside cap. Remember, I had mentioned that, maybe I could put a calendar spread on this trade and juice it a little bit. Yeah, I'm a little bit leery of that. So again, here, same thing. If we move up, I need to look at doing something to allow more upside run in this particular trade. This one's set up fine for upside. This one's going to be a little dicey if we get that upside breakout, but on Friday, remember, I rolled this right wing up to take out some of the risk because there had been a significant amount more risk of loss to the upside on this trade. So these are all things that either were done or are in my consideration as I look at what appears to, at this point, still be a pretty bullish pattern. Now, if we take a look at our VIX, the volatility index, we can see that we did get that spike on that day of the CPI number coming out. I mean, this is where I would have loved to have had that butterfly fill, because if you haven't taken the deep dive butterfly course, we spend a significant amount of time in there as to when are the best times to put those trades on. And this is certainly one of those. When you get a spike in volatility, that means that you can enter those trades for less, meaning that you have a better reward to risk ratio if you can get that to happen. Now, as it is, our VIX is still up a little bit here. And if we get more pullback, I'd expect the VIX to, probably rise here a little bit, which, again, is great for entry. It's not ideal for our current trades. They're going to be impacted negatively a little bit, but not hugely, in a small uptick in volatility. If volatility drops, those trades are going to be impacted nicely. So if our market moves up, volatility usually will drop in that scenario, and that will help those positions. Now, if we look at the rut, which is our other trade, that flat fly trade, so the rut is kind of in a range. Again, as the rut neared the highs here on Friday, I believe I came out and posted in our community that I was not going to adjust that rut trade because of this overhead resistance. My expectation was that we would probably be getting a little bit of a pullback off of this resistance, and therefore I didn't want to, come in and put too much adjustment into this trade until I saw how that was maybe going to play out. So expectations on rut, I do still think we're going to have a little bit of a ceiling, at least for a short period of time here in this 2075 range. So, but I really think that we could get a little bit more pullback, probably down here into this 2000 range, maybe even 1975, and then probably a rally back up into this, 2060, 2070 range, maybe a little sideways chop, and then ultimately a breakout here as well, because we are making higher lows as we move up the chain here. One of the things we haven't really done recently, though, is make a higher high. That's why this resistance is maybe a little bit stronger. Rut overall has been a little bit weaker than some of the other, than the SPY or SPX in general, because of course the SPY and SPX contain those high-flying AI-related stocks, your NVIDIAs, Apples, Broadcoms, etc. of the world. So that's why that index is showing much more relative strength than what rut is showing. Now we can also look at the volatility of rut. That is, the RVX is the volatility of rut. And we can see that it's been kind of chopping around too, but it also is a little bit elevated here. Not hugely so, but it certainly isn't as low as it has been in recent weeks. So the fact that we have a little bit of increase in volatility in rut, we have a little bit of increase in volatility in the VIX, even though we're close to new highs, that also tells me that there's a little bit of a fear, if you will, in the market at this point. And those also can lead to a little bit more of a pullback. You also see that here in the volume on our down days. Anytime we've had a down day in SPY, again, we can't look at the volume in SPX because SPX is options. It's not an individual stock or an ETF. So we look at SPY as a proxy. Well, we can see pretty much any time we've had down days here, those down days have overwhelmed the volume on the up days. That can be an indication that the people that are holding these positions have what's called weak hands, meaning that they're quick to sell and lock in profits. And that can be an issue if you start breaking down. If we start breaking down through some of those areas that had previously been support, these people are going to flood to the exits trying to lock in whatever gains they have in Nvidia, Google, Apple, Amazon, etc. So we need to be aware of that if the downside were to accelerate. Again, I'm not really expecting that at this point, but the fact that the volume is higher on those down days is a little bit of a warning to me. The fact that the volatility is still elevated in RUT and in SPY a little bit is also tells me that it's not all smooth sailing. There are minor reasons to think that we might be going a little bit lower. So that's kind of sums up the market outlook here at this point. Thanks so much, everyone, and I'll look forward to seeing you in the alert service this week. Take care.